Hello student, this video will discuss learning objective 3 of chapter 5, exclusion provisions. Since we already talked about income, then now we are going to look at exclusions. Exclusion provisions. Tax laws allowing exclusions or deferrals are non-recognition provision. These provisions are number one, to subsidize or encourage particular activities, or number two, to be fair to taxpayers. And we can start with one most common exclusion. Municipal bond interest. This one, please see example 5-22 on page 5-22. Interest income from local, state, and U.S. bond investment is excluded from gross income. However, interest on U.S. government obligations such as Treasury bills is taxable for federal tax purposes, but exempt for state and local tax purposes. Next one, gain on the sale of personal residence. This one will relate it to you or most of you who are homeowners. Taxpayers meeting certain home ownership and use requirements can permanently exclude up to $250,000 for all other taxpayers or $500,000 for married joint filers of realized gains on the sale of their principal residence. And here are the requirements. Number one, ownership test. The taxpayer must have owned the residence for a total of 2 or more years during the 5-year period ending on the date of the sale. Number two, use test. The taxpayer must have used the residence for a total of 2 or more years during the 5-year period ending on the date of the sale. Number three, only one spouse needs to meet the tests to qualify for the exclusion. Number four, the exclusion is allowed for every 2 years. Number five, ownership and use of less than 2 years will prorate the exclusion amount. This one, please see example 5-23 on page 5-22. Fringe benefits. Most fringe benefits, for example, use of a company car, are included in gross income. However, certain qualifying fringe benefits are excluded from gross income. For this one, please see examples 5-23 and 24 on page 5-23. Let's see what kind of fringe benefits are actually excluded. For example, medical and dental health insurance coverage, you only pay a portion of it and your employers actually will pay the substantial amount of it. And also the life insurance coverage, employees include from income, the value of life insurance premium, and then also the minimums, really small. For example, use the pens, have free coffee, a cup of free coffee at work that's provided by the employers. That will be okay, as long as they're not substantial. So that will meet the minimum benefits definition. What about education related exclusion? To encourage taxpayers to participate in higher education, Congress excludes certain income for funds used for college education. For example, scholarships. Scholarships without any service or performance required, such as athletic scholarships. And Pell Grants that pay for tuition fees, books, supplies, and other equipment required for the student's course or courses are excluded. Scholarship for room and board must be included in gross income to be taxed. So anything goes except for room and board. Those are considered necessity. You still need to pay for it even if you're not going to school. So those, if you receive the money to pay for your room and board, you need to include that. This one, see example 5-26 on page 5-25. What about other educational subsidies? Taxpayer may exclude from gross income earning investment in qualified education plans such as the 529. This is based on the IRC, the Internal Revenue Code Section 529 plans, and Corvidale Education Savings Account, as long as they use the earnings to pay for qualifying education expenditures. The exclusion is subject to phase out based on MAGI. Exclusion that will reduce or mitigate the double taxation possibility. Gifts, inheritance, and life insurance proceeds are the common items to be excluded. Gifts and inheritances. Number one, if transfer is alive at the time of the transfer of property from him or her to the transferee, the property transfer is called a gift. Each taxpayer is entitled to give another individual $14,000 in 2014 without the recipient recognizing any income. Number two, if the transfer is deceased at the time of the transfer of property from estate to the transferee, the property transfer is called an inheritance. Currently, an individual can bequest his or her estate tax-free up to approximately $5.34 million in 2014. Both gifts and inheritance are subject to federal transfer tax, not the income tax. Life insurance proceeds are excluded from gross income. However, if the proceeds are paid over time instead of in a lump sum, the interests associated with such distribution are taxable. Early redemption of life insurance policy for cash value is ordinary income to be included. However, this does not apply to when a taxpayer who is terminally ill, certified to die within 24 months, to receive early life insurance proceeds for this early reception qualify as accelerated death benefits. See example 5-28, page 5-27. What about for those who reside in a foreign country, foreign earned income, or maybe military personnel stationed abroad? To prevent double taxation, tax for example, tax in a foreign country, and then again when the income being repatriated back to the U.S., then they're going to be taxed for the same income. So Congress allowed taxpayers to exclude foreign earned income up to an annual maximum amount. For example, in 2013, it's $97,600. So you can earn a foreign income of $97,600 and not subject to taxes. This amount will adjust according to inflation, so you may want to check this number every year. Taxpayers have the option to exclude such amount or itemize the amount of foreign taxes paid, whichever is more beneficial, by filing in Form 2555. This election by Form 2555 can be revoked, cannot claim exclusion for the subsequent tax years, and those who claim foreign income tax exclusion cannot claim any child tax credits even if their income does not exceed the threshold. So let's look at this example here. To qualify for foreign earned income tax exclusion, one must first be considered a resident of the foreign country, and second, live in the foreign country for 330 days for a 12-month period. So this example here, Courtney is considering a 1-year rotation in one of the EWD's overseas offices where she will be paid $120,000 for 340 days in residence. How much income can Courtney exclude in 2013? Well, here in 2013, the full exclusion is $97,600, but it's only she will be paid only for 340 days. So 340 divided by 365 days in the country, and then the days in a year. So she can exclude up to $90,915 for her foreign earned income. What about sickness and injury related exclusions? The most common one will be the workers' comp, right? Any payments a taxpayer receives from a state-sponsored workers' compensation plan are excluded from the taxpayer's gross income. Unemployment benefits are not workers' compensation. Payment associated with personal injury, any compensatory damages on account of a physical injury or sickness or emotional are excluded from gross income. However, any punitive damages on account of a physical injury or sickness or emotional are included in gross income, which means compensatory damages award is to compensate you. Punitive is sort of like on top of the compensation, you also receive something to prevent the offender to repeat the same kind of offense. And so for this one, we may want to look at example 5-13 on page 5-29. What about healthcare reimbursement? Any reimbursement a taxpayer receives from health and accident insurance policy for medical expenses paid by the taxpayer during the current year is excluded from income. What about disability insurance? If an individual purchases disability insurance directly, the cost of the policy is not deductible, but any disability benefits are excluded from income. Only payments taxpayer receive from an employee purchase policy are excluded from an employee's gross income. Reference example 5-31 on page 5-30. What about deferral provisions? Deferral provisions allow taxpayers to defer but not to permanently exclude the recognition of certain types of realized income. Here are 4 common types of deferred income. Number 1, installment sales. Number 2, like-kind exchanges. Number 3, involuntary conversions. And number 4, contribution to non-Roth qualified retirement accounts. So for this learning objective, we discuss exclusion provisions. What can be excluded from gross income and what cannot be excluded. Also, what can be deferred but not completely or permanently excluded from gross income. For those of you who have questions, post your questions on virtual office or discussion on the week which this chapter is assigned. Thank you.